Good afternoon, everyone. Good afternoon, everyone.
Good afternoon, sir.
Quickly, please, all of you in the chat box, all of you, against your name, put your USN number. We require it for your attendance purpose. In the next 5 minutes, I'm going to take the attendance. Against your name in the chat box, please mention your name and USN number. Of course, your name will come. Mention your USN number. Okay, we'll start with the class. There are 10 members here. Okay. Fine. So in my previous class, we stopped at this particular slide. Am I audible?
Yes, sir.
Okay. So in the previous class, we stopped at this particular slide wherein we try to ensure how can we protect ourselves. I'll just refresh things. There are two types of risks. One is systematic risk and the second one is unsystematic risk. I'll just take you to that particular slide so things are clear. So basically we are talking about two components of risk. One is systematic risk and second is unsystematic risk. Okay. Now this type of risk that we have, we call it as uncontrollable. You cannot control it. Okay. Not controlled. You cannot control it. Is that clear? You cannot control this particular risk. So when you cannot control it, you have to face this particular risk. There is no doubt about it. On the other hand, this risk that we have, the unsystematic risk that we have, this risk we can control it. How can we control it? If we have a better business strategy, if we have a better business policy, if we ensure that our people are good enough, we can control this unsystematic risk. Is it not possible to control the internal risk? Is it not possible to control this type of a risk? It is definitely possible. Okay, can we not control the manpower planning? Can we not control the production planning? We can control all this. So this type of a risk, we call it as a unsystematic risk because this is a risk that only you are going to face. So we call it as a unique risk also. We call it as an unsystematic risk also. We also call this particular risk as a diversifiable risk. In other words, we can ensure that this risk can become zero or we don't face this particular risk. But when it comes to the unsystematic risk, when it comes to this part, we cannot control this particular risk. That is the reason it is called uncontrollable risk. And since we cannot control this particular risk, we have to face all these types of risks. We have to face all this type of risk. The only thing that we can do is we can reduce the effect of this particular risk. We can reduce the effect of this particular risk, but we cannot make this particular risk as zero. We cannot make this particular risk as zero. We can only reduce this particular risk. Now, in order to ensure how can we reduce this particular risk, we have to look for different mechanisms, right? Now, today in today's class, what we are going to discuss, we are going to discuss what are the different mechanisms by which we can reduce this particular risk. I repeat once again, I repeat once again, this particular risk, systematic risk, we cannot, we cannot make it zero. We have to face this particular risk. The only option that is left to us is we can reduce this particular risk. We can only reduce this particular risk. On the other hand, this risk that is there with us, this risk that we get, we can completely make it zero, and we can make this zero by diversifying our portfolio. Okay, we can make this particular risk by diversifying our portfolio. Okay, now what we are doing is we are only studying this part. In today's discussion, what we are doing is we are only studying this part. Okay, so that is what I want to make things clear for you, so that you will not be able to, you will not get confused with this. Clear? So this is what we are going to talk about in the upcoming slides. So we have seen what are the different types of risks. Now what we are going to see, we are going to see how do we reduce this particular risk. Okay, now when it comes to the first part, I told you that systematic risk consists of three parts. One is market, second is the interest rate risk, and third is the protection risk or the inflation risk. Now, how do we ensure that we get protection from the market risk? We have to look at how is the market behaving in the history. How has market behaved in the history? Because one thing is very common here, it says history will repeat itself. So if 2 years behind, if things were bad, that means today things can definitely be good, but 2 years hence things can again go bad. Okay, now if this is the situation, that means if this is the history of the stock markets, then we need to take into consideration two important parameters, and those two important parameters are what is the deviation that we are facing in that particular market, how much the market is going up and how much the market is going down, again how much it is going up, how much it is going down. This is what we call as the deviation pattern. So from the mean line, from this particular line that we have, how much the market is going up, and from this particular line how much the market is going down. If we have to calculate this, we have to estimate our standard deviation. Okay, there's one more component here which we call it as the beta, or which we call it as the systematic, or we call it as the sensitivity analysis. Okay, we call this by the name sensitivity analysis. Now sensitivity analysis means, okay, it gives you how sensitive is your share, how sensitive is your share to the market, how sensitive is your share to the market. In other words, sorry, in other words, how much of attention you should pay to this particular factor is what we have to understand. Okay, so when we come to the calculation part, I will be able to explain to you in detail what do you mean by beta. Beta in simple words means it is a sensitivity of the stock to the index. Suppose I'm just giving an example. Suppose I do my calculation and my beta value comes to say somewhere around 1.5. I'm just giving a hypothetical case. I calculate my beta and my beta comes to 1.5. What does this mean? It means that if the market goes up by 1%, if the market goes up by 1%, your share, which has a beta of 1.5, will go up by 1.5%. In other words, let us say, for a simple reason, let us say all of you have a share of a company called as TCS. Okay, you have a share of a company called as TCS. Okay, and the price of TCS is somewhere around 2,400 odd. Let us keep it 2,400. Okay, and it has a beta of around, let us say it has a beta of around 1.5. 1.5%. What does this mean? It means that if today the stock market goes up by 1%, if today the stock market goes up by 1%, okay, your share that is TCS, your share that is TCS will go up by 1.5%. That is what it means. That is what we call as sensitivity of the market. In other words, if the stock market goes up by 10% today, your share will go up by 15% today. If the stock market falls down by 1%, your share is going to fall down also by 1.5%. So beta talks about the sensitivity of the stock with respect to the market. And when we talk about market, we are overall talking about the index in that particular market. Is that clear? Any doubts in understanding this particular logic here? I'll just wait for some time.
So for calculation of standard deviation and beta, they are independent, sir, or they are interdependent?
No, beta is an independent calculation. Standard deviation is an independent calculation. Both are separate calculations.
Oh, yes, sir.
Okay, I'll just explain to you in the next upcoming slide. Okay, so basically what I want to tell you is we have to ensure that we reduce our risk, and to reduce our risk, this is the important calculation. Okay, we are going to study this part. Okay, interest rate risk in the next module. So I'm not going to discuss interest rate risk when it comes to holding period maturity, treasury bill, maturity, difference in maturities. All this thing we'll be studying in the next module. So I'm not going to touch this. I'm going to specifically talk only about this part, nothing else. Only about this part I'm going to talk about. That is standard deviation and beta. And how do we hold, to what time we should hold the stock, and when should we reap the benefits out of this particular stock. That is what we are going to talk about. Is that clear? Next. Now, we were discussing the most important component that we're discussing so far. We were discussing about the risk component of it. In stock market transactions, or when we come to invest, when it comes to investment in stock markets, there are always two things that drives investors. One is the return part of it, how much I'm going to get. So that is the return part of it. Okay. The next part is, to get this particular return, how much of risk I am going to take, right? To get this particular return, how much of risk is what I am going to take. So risk and return. Okay, so risk and return is what we have to take into consideration as far as the stock market calculation is concerned. Clear? So always there is an important ratio called as risk return ratio. So we call it as risk, okay, divided by the return. So we always have the risk return ratio, and this particular ratio is very important when it comes to having a suitable risk associated with that particular investment, and also expecting a certain amount of return. Is that clear? Any doubts in this? Now, when it comes to risk management, as I told you, there are two major components. One is the variance, okay, or the standard deviation. Okay, I think all of you know what is variance and standard deviation. Okay, what is
Yes, sir.
What do you mean by standard deviation? What do you mean by standard deviation? All of you have gone silent. All of you
Sir,
asked for standard deviation.
sir,
Yes.
sir, standard deviation is the sum of the averages of the given values, sir.
Sum of the average.
Whereas,
No.
uh,
Okay, I'll give you a very simple example. See that if you can understand this. Let us say, okay, all of you have seen VTU.
yes, sir. No, sir.
Okay, fine. Let us say, I'll just give you a very simple example. Let me see if you can follow this. Okay, let's say that this is a road. Okay, this is a main road. Okay, let me say that this is what I say. I can say, fine. Let me say this is third gate. Okay, let me say this is third gate. Okay, and this is KLE. Okay, and you have this road in between. This is the main road that we have. Now somewhere, let us suppose that the width of this particular road is what we require. We require at least 80 feet of road. Okay, we require 80 feet of road. But somewhere the road is around 100 feet, somewhere the road is only 60 feet, somewhere again there is a twist, right? So all these things are happening. Are you able to understand what I'm trying to tell you? So on an average, if you see, the road is not exactly 80 feet width. Somewhere it is 70 feet, somewhere it is 60 feet, somewhere it is 100 feet. So what is happening is, from this point, there is some deviation that we can observe. There is some erratic movement that we can observe. Can you see these movements? We want the mean of this particular road. On an average, the width of this particular road should be somewhere around, let us say, 80 feet. But somewhere the road is 70 feet, somewhere the road is 60 feet, somewhere the road is around 90 feet, somewhere the road is 100 feet. So on an average, there is some observation, some point wherein the road is going up or going down, going up and down. So this fluctuation is what you can see here. Okay. If these fluctuations are very high, that means the contractor who has constructed this particular road is not a good contractor. Why? Because there is a lot of deviation that is observed from the mean value. There's a lot of deviation that has been seen. We don't accept such projects. We will accept only those projects wherein the deviation is minimum. Say 5 feet here and there, we can understand, the ground level is not good. So all these things are a part and parcel of the construction industry. Now, what we need to understand is, when it comes to investment, we have to choose such a stock. Okay, we have to choose such a stock that does not experience a erratic movement in the stock markets. Imagine if you have a stock which keeps on moving on all this way daily. You don't know when to buy this particular stock, when to sell this particular stock. Are you able to understand my point? You're getting the logic here that I'm trying to tell you?
Yes, sir. So it means that it's a calculation of the measures which are spread out.
It is a standard deviation. It is a measure that points out how much more the value is deviating from its mean value. The mean is 80.
Yes, sir.
The mean is 80, and suppose my standard deviation comes to 10. What does it mean? It means somewhere the road is around 70 feet, somewhere the road is around 90 feet. So from its mean value of 80, the road has a deviation of only 10 feet above and 10 feet below. Suppose if my deviation is only 5, what does it mean? I am a good contractor, right? That means maximum the road is around 85 feet, not more than that. And the least is the road is 75 feet, not less than that. But on the other hand, I have a deviation of say 25. What does it mean? It means 80 plus 25 is how much? Somewhere the road is around 105 feet, and somewhere the road is around only 65 feet, right? This much is too much of deviation that we can observe. We don't want such deviations to be observed. In stock markets also, whenever we invest into shares, we have to check for those shares which offer the least amount of deviation and a good amount of return. So that is where the trick of stock market comes into picture. We have to select such shares wherein the deviation is minimum and the returns are maximum.
Mummy.
Kaka, please unmute. Is that clear? Are you able to understand what I'm talking to you about deviations? Now, if you have understood the meaning of this particular deviation, I think understanding this particular formula won't be of much difficult for you. I think this formula is what you have studied in your first semester.
Yes, sir. Square of the standard deviations.
Okay. So square of standard deviation is variance. So how do you calculate that particular variance is been mentioned to you in this particular formula. What I want is, I want you to make a note of this particular formula. Okay. I'll just see to it that, all this thing has been erased. Please make a note of this particular formula. Okay. Please make a note of this particular formula. This formula is very important for you. I will tell you what are these notations. What do you mean by P? What do you mean by R? What do you mean by E? All those things I will let you know. But see to it that you understand this particular formula. Please make a note of this particular formula. Sorry. Done with the done with taking down the formula?
Yes, sir. Yes, sir.
Okay. Now, in this case, please understand, I'm telling you the notations for this particular formula. So please make a note of this. Okay. You can see the mouse pointer, right? All of you can see the mouse pointer. All of you can you see
No,
the
sir.
mouse pointer?
No, sir. No, sir. No, sir.
Can you see the screen?
Yes, sir. See the screen.
Okay. I'm just telling you. This is variance, right? This this sign is called sigma. Okay, this particular sign we call it as we call it as sigma. Okay, we call it as sigma. Okay, this is nothing but summation. I think you know this. P in this particular formula, P stands for probability. P stands for probability. Okay, P stands for probability. Next, this particular value Ri. Ri stands for return from your stock. Ri means return from your stock. Return from your stock. That means what is your current return? That is what you are earning. That is what we call as return from the stock. Next, we have there is a term called as ER. Okay, ER stands for expected return. How much do you expect the share will earn in the next 1 year? If I ask you this particular question, you will arrive at a particular value, and that value is nothing but your expected return. Okay, that is what we call as expected return. Okay, now if you come down, this is square, this is sigma square. Okay, sigma square is always variance. If I take square root of that, okay, if I take a square root of that, so it comes to sigma under root the entire answer. So okay, this is under root the entire answer. I think things are now it is very clear. You want me to repeat once again? Because there was too much of mess here.
Yes, sir.
You want me to repeat?
Yes, sir.
Okay. This is a formula for variance and standard deviation. Standard deviation, square of standard deviation is nothing but variance. Okay. Square of standard deviation is variance. So we'll first try to understand what is standard deviation. So standard deviation is always denoted by the letter sigma. Okay, so sigma is equal to under root. I think in your statistics class you have learned all this, but the only difference that you have learned here is you have divided this by n, right?
N minus 1. Yes, sir.
Yes, sir.
Okay, n minus
N
1.
minus.
N minus 1. Okay, this is what you have learned. Clear? But here I have not taken it. Here I have not written it as n minus 1. There is a reason for this. Okay, the reason is when you studied statistics and when you studied the formula for deviation, this was the formula that you studied, but in this the formula that you studied, there was no p here.
Yes, sir.
Okay, there was no p there. That means you always estimated deviation for things that have already happened. Okay, if I ask you calculate what is the average rainfall that has happened, what will you do? You will take past data and tell me how much of average rainfall has happened. So you come to a mean, right, that on an average in the last 10 days 50 mm of rainfall has happened in Belgaum city. This is what you can tell me. Okay, so the average rainfall in Belgaum city in the last 10 days was 50 mm. Okay, agreed. If I ask you, Rohin, what was the highest rainfall that happened in the last 10 days and what was the lowest rainfall that happened in 10 days, you will not be able to tell me. So in that case, you will identify what is the deviation. Okay, so based on the deviation, you will come to know how much is the variation that is happening. Someday it might rain 100 mm, someday it might rain only 10 mm, but on an average, it is around 50 mm of rainfall. Okay, so based on that, you could find out and tell me what is the deviation. But in that particular calculation, there was no mention of the value as p, because p always stands for probability and probability is always for the future, right? So statistics formula that you have studied for calculation of deviation is this one, is the formula that I have mentioned here, but without p. Okay, so you have studied this particular formula, but you have studied it without p, because p talks about probability, and whenever we talk about probability, there is no divided by n minus 1. If I calculate only the deviation that was there in the last few days, then whatever formula that you have studied, the same formula will be applicable. But here we are not interested in what has happened. In the stock market, we are not interested in what has happened. We are more interested in what will happen. What will happen if I purchase shares of ACC Cement? If I ask you this question, okay, will the share go up or will the share go down? If I ask you this question, what will you check? You will check, okay, what is the overall behavior of that particular share in the last 1 month or so, and based on the data, you can tell me, fine, I think that there is a 25% chance that the share will go up and there is a 25% chance that the share will go down, but there's a 50% chance that the share will remain as it is, which means it is going to be a stable movement here somewhere. Clear? So when I have to talk in future, I always have to include the word probability. Are you able to get my point here? Whenever I have to talk about future, I always have to talk about probability. So this factor has to be added in your formula. Any doubts in this? I'm going very slow because I have to unlearn some things from you, okay, and I have to teach you new things. That is the reason I'm going very, very slow. Any doubts in understanding this? Again, I repeat 2 points. First thing is, in stock markets, we are more interested in what will happen. We are not interested in what has happened or what has already gone. We are not much interested. What will happen if I purchase shares of L&T today? Will the share go up or will the share go down? If I have to ask you this particular question, I need to tell you what is likely to happen in the near future. So whenever we are talking about future, there is one thing that constantly comes into calculation, and that is nothing but the word is probability. So probability comes into picture. So whenever we are calculating variance for a particular stock, or whenever we are calculating standard deviation for a particular stock, and we are doing this calculation for some day in future, the word probability will come into picture. Here also P will come into picture. Here also P will come into picture. Any doubts in understanding this?
No, sir.
I want some response from other students also.
No, sir.
Any other
No,
doubts?
sir.
Rohit, Nunali, I think Nunali has just answered. Others, please respond if you have understood this. And by the way, today I'm going to take an extra class because yesterday I was on leave and I could not take the class. So I'll make up for that particular class today itself. Okay. So after once your all classes are done, I'm going to take one more class to cover up investment management. And tomorrow I'll take one more class to cover up tax management. Is that clear?
Yes, sir.
Yes, sir.
Okay. By the way, before I stop for this class, how was your internal test?
Sir, it was good,
was
sir. But in the tax, there was some problem in the question, sir.
Yeah,
182 days will be there.
tax thing we'll
But
discuss when we come to
You
tax
have put the
class.
option like
Yes.
160 days.
Yeah, for all those who have answered that particular question, all will get marks. Don't worry about it. Because the entry itself was, it was 162 two times. Actually, the right answer should have been 182.
182 days.
Right? Yeah. So those things will be addressed and give marks. to
Sir, but in the question 21st, sir, you have asked the exemption of the gratuity two times, sir. 21st question and
We'll come
but the options are.
when we come to tax class. We'll discuss all those things. Not in
Yes, sir. Yes, sir. Yes, sir.
So we'll. I'm just revising once again. Okay, what we have done so far is we have understood that risk cannot be eliminated. We have to face the risk. The only chance is we can reduce the risk. Okay. So in order to reduce the risk, first task is we need to estimate what is the risk. And to estimate the risk, the common parameters that we use is, okay, the common parameters that we use is standard deviation. We use standard deviation and we use standard deviation and we use beta as a measure to estimate the risk. Once we estimate the risk, then we can think of reducing that particular risk. So how do we reduce that particular risk? We will see it later. First thing is we have to put a value to that particular risk. And in order to ensure that we put a value to that particular risk, we have to calculate variance of that particular stock. Okay, variance, or you can say standard deviation of that particular stock. Once we calculate variance and standard deviation of that particular stock, then we can think of, okay, are we able, or are we in a position to handle this amount of risk, or should we look for something else? So all these aspects we are going to see in the next class. Today what we have done is we have understood only one part of it. We have estimated, or we have tried to see what do you mean by risk management and what is the first common method that we use, not to reduce the risk but to ascertain what is the present level of risk. In order to assess what is the present level of risk, we use a measure, or we use a calculation technique, and that particular technique is what we call by the name variance analysis, or we call it as standard deviation calculations. So we have done, I have just told you the formula for standard deviation, and in that particular formula also I have very clearly told you when to use P and when not to use P. P stands for probability. Whenever you are making any calculations for future, you always have to use probability. Whenever you are making calculations for the past, you don't have to use probability. Again, whenever you are making calculations for the future, there is no n minus 1 in the denominator. Whereas whenever you are making calculation for the past, there is always n minus 1 in the denominator. So these things you have to take into consideration. Most of our calculations will be in probability basis. That means will be on future basis. So we will not be able to use, so we should not use n minus 1 as in the denominator. Whereas we have to use probability in the numerator part of it and then make the calculations. Is this part clear?
Yes, sir.
Yes, sir.
No doubts as far as this particular part is concerned?
No, sir.
I told you to take down these two formulas. This is the formula for variance, and square root of variance is nothing but standard deviation. So these two formulas are important, not only for calculation part, but also for your projects, if you want to do your projects in this particular field. One more point that I would like to stress, I have not given any assignment till so far because I had to complete 2 modules, and assignments can be given only on after completion of 2 modules. That is what is mentioned in the syllabus, because this the assignments mentioned in your syllabus start only from the second module. So today I will be giving you one assignment. Okay, it is all module 1 and module 2. Okay, so altogether you will have 3 assignments. Module 1, module 2 is one assignment, 3 and 4 is second assignment, and fifth and sixth is the third assignment. So totally you will have only 3 assignments in investment management. Today, after all classes are over, I will take one extra class. In that particular class, we'll proceed from risk measurement to the next slide, and I will also float the assignment for your investment management class. Please make sure you have to write those assignments, scan it in a PDF and mail it to me. Okay, it is not an online assignment. You have to download it, write that particular assignment, scan it, and then upload the same on the WhatsApp group. Narayan has created a WhatsApp group only for finance students. I request everyone to join that group. Is that okay? So
Yes, sir.
please don't go. I'll just check for the final attendance as to how many people have attended.
So at what time you'll take the class?
I will let you know after the last class. Whenever is the last class, I think 2:30 to.
So I think we don't have Prayag sir's class now.
After MB Patil sir's class, I will be engaging that particular class. Today's last class is MB Patil sir's class. Post that, I will be engaging the class.
Okay, sir.
Okay, but I will have to finish it because it is pending.
So I think Prayag sir is not taking class now. We have HR analytics.
What happened?
So we have HR analytics class now. I think Prayag sir is not engaging it.
I'll just check. If he's not engaging, then I will take it.
Yes, sir.
If he's not engaging, then I will take it. But if he's engaging, then there's no option.
Okay, sir.
Take after the regular classes.
Yes, sir.
Okay. Yeah. You can leave. I'll just let you know if things are there. I'll let you know.
Yes, sir.